In this video, we will cover the sales side of transactions using the net method. There is a separate video for the purchase side of the transactions for Hammond Company that you see here on the screen. But in this video, we're going to look at the other side. We're going to look at Zelda Incorporated's books. So here we have Hammond Company. They purchased merchandise on account. This means they charged them from Zelda's for $80,000. Terms of the sale were 2% if paid within 10 days, otherwise the net is due in 30 days. You read this the same whether the numbers are 1% within 15 days, net due in 45 days, 1% in 20 days, net due EOM, which is end of the month. All of it reads the same. So that means if the company pays, they are entitled to take some discount. Companies typically will try to take discounts they are offered, even going to borrow money sometimes, because the cost of borrowing the money is still cheaper than losing the discount. So because so many companies do take advantage of this, we often will see that they prepare journal entries and record purchases and sales using the net method at the beginning. And then we'll look at what you do if that customer does not actually are not entitled to take the discount. Then you go back and recognize additional revenue in this case. So over on the right hand side, you see I've prepared some math for you there. The 80,000 times 2% equals 16,000. In this column is what I'm talking about. 80,000 minus that 1,600 leaves 78,400. Or you can do it in one step if you're comfortable with this. 100% minus the 2% means that they will be paying actually 98% of the total. 80,000 times 98%, 78,400. So you can do it in one step if you're comfortable using the method on the bottom, but if you're not, the two-step method will always work. So Hammond Company owes Zelda at the net method $78,400. So we're going to record the accounts receivable at $78,400, and we're going to record sales revenue with a credit of $78,400. Notice also in the problem we were given the cost of the goods that have been sold is $71,000. So that means when we record our sales, we need to also record this cost of the goods that have been sold in this transaction. So when you have sales transactions, you're going to have two now. And if you're working out of a textbook, you'll see that you're going to be given two sets of numbers. In the real world, you'd have to know what those numbers are and calculate them yourself. But for our problems, we're often going to be told what the numbers are, and so we can just take that and know that we need to do something with both numbers in this case. So cost of the goods sold is an expense account. Doesn't have the word expense on it, but it is often the largest expense account for a merchandising company. So this increases the amount of that expense with a debit. It removes those items from inventory with a credit to the account. So remember, we are using perpetual. We recognize perpetual inventory system in this problem. The other method would be the periodic system, but in the real world, people use the perpetual. This means that it's constantly updated. So as merchandise flows in and out of the inventory account and physically, we go ahead and prepare those journal entries and recognize that as such. Number two, prepare the journal entry, record the receipt of payment, assuming that the Hammond Company pays the discount within the discount period. So we go out, we get an envelope out of the mailbox, and it's a check from Hammond Company, and it's for $78,400. They paid within the proper time, so this is what it should be. So we're going to record cash in $78,400, and we're going to credit the accounts receivable Hammond Company for $78,400. They have paid us in full. Now for the third item. Here let's assume that Hammond Company does not pay within the discount period. So how much do they owe the company in this case? Well, they owe them the full $80,000, right? So We go out to the mailbox, and instead of that smaller check, we now have a check for $80,000. We carry currently Hammond Company on the books at $78,400. So we're going to give credit to that account, and you'll see that we are off. We need the total of the debits to always be equal to the total of the credits. That is not the case now. There is a difference of $1,600, which turns out is the amount of that original discount that we reduced the invoice by. Now what do we do with that? Well, because we are talking about sales revenue, we're actually going to increase the amount of sales revenue by that $1,600. So credit sales revenue for the difference. Now let's talk a moment about adjusting entries that are required for possible customer returns and allowances. Sellers are required to estimate returns and allowances at the end of their accounting period, and they prepare two adjusting entries. The first adjusting entry would reduce the sales account. This is your sales revenue, and it creates a customer refund liability account. Your liability account is for estimating the refunds and allowances that will be paid or granted to customers in the future, so they may have to be paid out in cash or some credit given to their accounts. The second adjusting entry creates an estimated returns to inventory account for merchandise that is expected to be returned, and then a credit is made to the cost of the goods sold, which reduces the cost of the goods sold. So let's look at some examples of how to apply those. Going back to our same sales before, we had Zelda Company and Hammond Company. So in this case, merchandise was sold for $10,000. It had been discounted at 2%, and it is returned after the customer makes payment. Cost of the merchandise, $7,500. So in this case, we want to, let me get that off there. We want to debit the customer refunds payable. Remember, we would have already created those accounts with adjusting entries. Now we are doing the opposite. We actually have some goods that have been returned, and so we're going to now make the proper entries into the account. This is not your adjusting entry. The adjusting entry would be for some percent at the end of the period. There we go, based on prior history, so some estimates that would be put into these accounts. Notice the credit to the customer refunds payable, the debit to the estimated returns, inventory, etc. So now in this case, we actually have a return, so we're going to be utilizing those accounts by making the opposite entry. So in this case, you would debit the customer refunds payable, and they've already paid, so a check's going to have to be cut. Thus, you credit the cash. And then the merchandise is being put back into the inventory. So $7,500 is the value or cost of that merchandise that's come back. And so you need to debit the merchandise inventory account, which increases it. And then you're going to credit the estimated returns inventory. Okay, now let's look at the second item. So here we have the same merchandise valued at $10,000, discounted at 2%, so that's your same $9,800, and it is returned prior to the customer making payment. The value of the merchandise still $7,500. So this is on Zelda's books again. Customer refund payable, still going to be $9,800. The only real difference that we have here now is the customer. See, the Hammond Company is the customer, and we're going to credit their account. They haven't paid us yet, so we just give them credit into that account, so that's less that they're going to need to pay us, but we won't have to cut a check directly because we're going to credit the account, so that's going to make less that they owe us. Okay, so this is examples of how to prepare your entries for the sales side of transactions on Zelda's books. Be sure to have a look at Hammond Company's purchase of merchandise video so you can see how all of these transactions and numbers tie together.